I'm Jesse Mackey, Chief Investment Officer of 4Thought Financial Group. This is the first video installment of our weekly market perspective. We've already been doing this for years in written form for our clients, but this is the first time we're bringing it to a wider audience in video form. We intend to do this every week, so please let us know if you like it by subscribing to our blog feed and following our Facebook and LinkedIn pages. But here we go. Global stocks have experienced a massive relief rally during the last month after moving swiftly and deeply into a bear market during the prior month, but they continue to experience very high volatility. The most recent low point for the S&P 500 index of U.S. large-cap stocks was on March 23rd, at which point it had dropped more than 34% from the record peak achieved on February 19th. Since then, it has steeply rallied, but it was still 16.81% below the recent record peak as of the close of business yesterday on April 20th. So historical market type statistical analysis reveals that once a bear market is confirmed, which occurred on March 11th, the average time to the trough of the cycle is approximately 5 to 6 months later. The average additional loss is approximately 16.72% from the bear confirmation point, although both the time to the trough and the actual cumulative loss can vary pretty widely depending on the time period referenced. For long-term investors, this window has historically proven a very opportune time to deploy any excess cash accumulated in bank checking and savings accounts that's not needed for short-term expenses or savings goals, or to supplement household living expenses in the event of a temporary loss of earned income. In the current scenario, this cash deployment should take the form of an immediate initial lump sum injection of 60% of the total investable cash, with the remainder dollar cost averaging at 10% increments over the next 4 months. Long-term investors should immediately speak to their advisors regarding whether and how to implement this, based on their particular financial situation, of course. From a probabilistic analysis perspective, stocks range from roughly fair valuation to moderately undervalued. And the valuation differences between bond types are much wider. And they range from significantly overvalued in the case of long-term U.S. Treasury bonds to moderately undervalued in the case of emerging markets bonds. Against this backdrop, the outlook for stocks is now positive in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. U.S. aggregate bonds driven by Treasury securities are now the strongest performance so far in 2020, while U.S. small-cap stocks show the worst year-to-date performance. U.S. mid-cap stocks now reflect the most attractive pricing relative to the alternatives, while long-term U.S. Treasury bonds are by far the least attractive. With regards to allocations amongst investment methods, we're now allowing overweight allocations to strategic asset allocation, neutral allocations to liability-driven investing, and underweights to selective concentrated investing and opportunistic investing. So I hope this was helpful. If you have questions or you'd like to discuss how to implement any of this, please contact 4Thought at 516-300-1617 or info@4tfg.com. Thanks, and see you next week.